Right, stocks continue to climb today, but in a much smaller pace. Like the pace has been gradually getting smaller and smaller. So we'll break down that today. There's actually a few signs that we're seeing right now that look very, very similar to a move that we saw last year during the intermediate decline. So I'm going to break down what those two signs are in particular, and how it looked then, how it looks now, what the expectation would be now based off of that analog playing out. Of course, the expectation here is a new bullish intermediate decline or rally starting. The question now is how strong that rally will be if we get one at all, if this analog plays out. So we'll break all that down, what the expectations are, some other patterns that we've seen in prior correction cycles, in terms of how some of this intermarket relationships are performing and how the sector moves. We have one sector that's just absolutely dominating the others right now, and it's probably not the one that you would think based off of how bullish the markets have been. So we'll take a look at that. We will take a look at a trade in the sector probably everybody does think has been the big winner lately. It has been pretty darn close. It's right up there in second place, actually. So we'll take a look at a stock within that sector, very popular, common sector for everybody, but not a popular industry or a stock within that sector, not one of the big names, so to speak. We'll take a look at a stock that looks like it's got a new bullish trend going itself. And we'll talk about how to trade that. So let's go ahead and get started. Today is Tuesday, May the 7th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I take a look at old trades, see whether we should stay in them. We got out of another one, I think another two today, and then put on today's trade idea before the market close. Come down to the bottom, click this heart, it opens up this tab, hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab, hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. It's very big to us, is why we always ask for that. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. And we can get to our 100 goal on tweets, on our likes for our Market Outlook tweet. We're going to start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the intermediate line has crossed above the chart's midpoint here, above the 50th percentile. Still is below market sentiment. Market sentiment still falling slightly. Actually, it looks like it's pretty darn close to turning back up again. But we are still in neutral territory in the intermediate line, not quite in bullish territory yet. Needs to get above the 60th percentile, and it's really bullish when you're above the market sentiment line. So we're not quite there yet, but we're getting again, we're moving in the right direction. The fact that the near-term line is finished now twice, 2 days in a row up here at these extreme highs, very, very good sign from a short-term sentiment standpoint. Your momentum line dipped a little bit, but that's okay. That's not surprising. In fact, the main reason why it's dipped is because of this small range. We just get, today's range was just extremely light. They're at only 21 points, as you can see, relative to 62 average. So that's the only difference here. And the other kind of big difference, too, is, when we got that bear tag a couple days after this last bear tag here, we were nearly 2% or over 2% above the moving average. We're still just barely over 1%. We need to kind of get to this 2.5% mark and break through that to really feel confident that we have a strong bullish trend going. And we can get a bullish trend going, but again, we can get one going that's only like a month long or two. We've already been over 2 weeks now, going on 3 weeks off of these lows, and we still haven't even gotten a from that cluster low to the bear tag, now past the bear tag. First of all, it took 12 days to get to the bear tag. Over here, it only took 1, 2, 3, 4 days. But to get to dark green shading and a green line, we went from cluster to 1, 2, 3, 4, 5, 6 days to get the dark green shading and the green line. we've been 12 days now, and we're not there yet. Now we got dark green shading, but you don't have the green line, which is a you kind of need a good. We have to pull the moving average up. You have to be above it by a good amount to start pulling it up for that to happen. So it kind of goes to show just how long and how weak this current bullish trend has been, and maybe just how weak ultimately it will be. It doesn't mean that we might not get one. We still have to be aware of a failure at this bear tag. We haven't really built on the bear tag yet, so we have to be aware of a potential failure. But as of right now, so far so good. If you look at the NASDAQ 100, it looks pretty similar, a little bit closer to getting above market sentiment, and we're 2 days past the bear tag, and so a little bit more. We still don't have the green arrow yet. You do have the dark green shading because of the jump above the 50th percentile. Looking at the Dow Jones Industrial Average, it was a little bit weaker performer today because of Disney really impacting that negatively, and as a result, not only is it not above the 50th percentile, so we have dark green shading. It's also not even out of bearish territory yet. Still below the 40th percentile, barely. Also still below market sentiment, even though market sentiment is a lot lower than it is on the S&P, and we're not even 1% above. So it's hard to get the moving average turning higher when you're, like I said, back here you're close to 2%, and we're not even 1% above the moving average. So that's a big difference there on the Dow Jones, and of course, your Russell 2000 looks pretty similar to the Dow. Again, you are out of bearish territory, but you're not above the chart's midpoint yet, so you don't have the dark green shading yet. You are nearly 2% above the moving average, so we probably we might just be a day away from green line from the moving average actually turning higher. So we'll kind of keep that in mind tomorrow as when we get our new candle here tomorrow. And if we can cross, it looks like we might be able to cross above the chart's midpoint and get green shading and the market sentiment line maybe at the same time. So if we can get a good day tomorrow, now granted we've been up 5 days in a row in the Russell 2000, so it'd be a 6th day in a row here, and it's it hasn't been as common here to get 6 days in a row on the Russell. If you take a look at IWM, you can see the 6 days in a row there. So you have to kind of go back. Let's see when there was 5 days in a row right there, with 2 of them being above 2%. We haven't had any of these be above 2%. This is 5 days in a row. That was 5 days in a row. And then we had 5 days in a row here. We had 8 out of 9, but it only got the 5 days. And there we had 6 days. Again, kind of like what we got right now. And then you ended up with 1% decline. So, we'll kind of keep our eyes on this and see, what this turns into. But if we can get a good strong 2% gain tomorrow, you probably will break through the above the market sentiment line and clearly above the chart's midpoint, and you'll have a green line. More than likely, you'd have a green line as well. So let's see how the market responds and see if we can get a winning streak that we haven't seen very much here on the Russell lately in the past year. Let's take a look now at the weekly chart. Remember, we had talked about it turned bullish. It's still bullish, right? The high point, the close is above the high of that transition. So that's a good reversal pattern there. So everything is looking really good from that perspective. And your Dow Jones is the one that's been a little bit weaker. If you take a look at the Dow Jones Industrial Average here, its high point last week was 38,808, and right now our close is at 38,828. So we're just a little bit above that high point as well. So even the weakest one is showing some pretty good signs. You have 3 green arrows for 3 days now on all across the board, right? On everything, 2 days on the S&P, really close to 3. But 3 days everywhere else, you can see the 3 green arrows. So that's a very good development there. Really would cement it with the line turning green, the moving average turning green. So in other words, turning back up. Obviously, you're above all these short-term moving averages, the 8 and 17 day. You're also above the 30 and the 50 still. And your 8's above the 17, so your MACD is turned positive. And you're close to crossing above the 30 and 50 day moving average. So that's a good. We're moving in the right direction from that regard as well. Let's look at some of the other DMI, other oscillators. Your DMI is bullish. It's not strongly bullish, right? You're still just barely below 25 on the negative, and still barely above 25. So it's a positive change. And your ADX is still above 20, but it's probably going to drop below 20 tomorrow, barring a big move to the upside here. So, you know, and again, we sure would like to see that negative indicator get a lot lower, so that we can feel really good again about, you know, getting this. You can see when you got that big bullish move, you know, in fact, you got above 30 on the positive. So even though you were just barely below 25, at least you're above 30, and that's just not the case yet here. So not the best sign there. You're not seeing a strong bullish pattern here yet either. We're not above 60 yet, so this is actually still red for the time being. Well, you know, we are above 50, and we'll see if this, if we will. We'd have to actually go back here to start at green, but we'll see if this ends up turning green or not. And we are above 150 on the CCI, so that's a positive sign too. Looking at the Ichimoku cloud, again, we don't have, you know, we are above the cloud. We still have a negative rate of change. That might be temporary here. We don't have a new bullish trend developed yet, so it could not quite, again, it kind of goes to show the weakness of this bullishness that we're getting. And like I said, it doesn't necessarily mean that we'll fail. I mean, even though like we did get above the cloud there, and we never did get a bullish trend going here either. So there's, just because we're above the cloud doesn't mean that we're out of the woods here. And so we'll kind of keep, you know, we have to be aware of the failure. But, you know, I still think there's a pretty decent chance we actually start a bullish move. I think that the bullish move, though, is going to be on the weak side, which, you know, again, we're so used to like 19% run and 27% run after intermediate declines. I doubt this is going to be even in the double digits, right? Might be closer to 10%, but might, and most likely won't be in the high double digits for sure. If you take a look at this chart too, on the stochastics, we did climb above the 90th percentile of the 4-week range. So when you look at it here on this, oh, we got to look at the Bollinger Bands. Let's look at the Bollinger Bands first, and then we'll come back to this. We are in the upper quartile again, still not up against the upper band. But at least in the upper quartile, you have the red dots, so the bands are inside the Keltner channels. The momentum is swung positive, so you know it's not a breakout, but at least it's in the right direction. Now let's take a look at the 4-week range. Again, we don't have a new 4-week high point yet, but we're only 2 days away from this coming off the table, and this at least will be the 4-week high. This is like the 1/3 straight day that the high and the low point has been above the prior day's high. So that was the case here, and then here. Now but the ranges have gotten gradually smaller and smaller and smaller. As you can see, the volume has really tapered off. Of course, we don't have the bullish crossover yet, but we're maybe a couple days away, depending upon how bullish we are tomorrow. We might get a new 4-week high point tomorrow and really kind of break this move. But we can also might fill in these gaps here sooner rather than later. So though, you know, kind of something we need to keep an eye on there too. I do think we'll be headed towards a new 4-week high point, as that appears to be the case. It is, you know, again, we're breaking through this moving average with small volumes and small ranges. That's not the best sign in terms of like kind of a breadth thrust type of move. And again, the other issue too that we continue to talk about is just how low volatility is. Not necessarily on a relative basis. You can see it's on an absolute basis, it's all the way down to 13. And we are, you know, we did move lower throughout the end of the day here below the 90th percentile. But we're still way, I mean, the extreme low down here is 80th. But the VVIX is still extremely low. So the VIX has been catching down. It's not, even though the VVIX is at, you know, its lowest point in years, the VIX is not even at the lowest point of the calendar year. So it kind of goes to show just how low the VVIX has dropped, and maybe setting us up for a pretty significant jump in the VVIX back up to the upside. So not only are we way below just on an absolute basis, but you can also see here, let's see, where was it at? VVIX. You can also see we are way below the 200-day moving it. You can see the volume, big drop here in the VVIX has caused this to come down. Last time we dropped this far, this fast from a momentum standpoint, that sparked a rally in the VVIX. And it was kind of like, again, just like last August 30th, this very similar type situation where we jumped up. We had, looked like we were going to start a new bullish trend. We bounced off lows, got a bear tag, went up a couple of days, got a good near-term line above the 90th percentile, and the VVIX dropped sharply, and then we had that leg. So again, we kind of need to be aware of that possibility. Never did get above the market sentiment line there because we failed and rolled over, and that's a possibility here too. So if the volatility in the VVIX start to jump up by the end of this week, and then we'll kind of know that we're kind of following a similar pattern of what we've already seen before in this past year. Right now, let's talk about what's driving this price action. It continues to be the same drivers, and this bullishness here has been led higher by a drop in yields. Though bonds today, you can see bonds continue to rally off their lows here, which means yields are coming off of their highs. Let's just look at just today alone. And you can see bonds were up again today. Real estate was up, kind of acting like a cyclical stock. And you can see the Qs were kind of flat. Emerging markets giving back some of their recent gains. Gold down with dollar strength. So the dollar was up. Commodities were relatively up. And then you can see, with bonds. But today the big mover was the continued drop in bond yields. So here's the 10-year yield flirting with that 30-day moving average. Still between the 30 and the 50. MACD is breaking below zero. Stochastics kind of at the, breaking into the lower reversal zone. Last time it broke into the lower reversal zone, we were flirting with the 30 and the 50, and we're kind of doing that again here. So again, over here you can see we were breaking the 50 by the time we got into the lower reversal zone. So much different scenario now. And dollar is the same thing. Now remember, the dollar bounced today back above its 30-day moving average. And you can see the histograms turning up. If we get back above this 105.5 level, that could signal a new leg higher for the dollar. And you would assume if the new leg higher for the dollar is going to happen, you'll probably get a renewed jump in yields. We've already seen a bounce in commodities. Didn't necessarily follow through today, though we are up off of the open. The close is higher than the open, and you can see the MACD is turning up. And the histogram has been turning up as well off this 50-day. So the three-headed monster has had a little bit of a pullback. Commodities have pulled back, yields have pulled back, the dollar's pulled back. Now they all appear to be trying to figure out a low point. And if they all three start to rally again, then we've seen in the past that that's been relatively bearish for risk appetite. One of the things I've tweeted out here is, let me pull this up here really quick. Excuse me. One of the things I've tweeted out here is utilities have been so bullish. You can see the return, again, off of this low point, off of its intermediate low point back in February. Utilities have been on a 58-day run that's been about 16%. This is the fifth largest in the last 20 years. One of the four is right here, and you can see that point right there was this point in time in 2022. Utilities had a strong run up to the upside on an outperforming basis, and it failed, right? It failed, and the whole market came down. Once it peaked at that 58-day level, the market came down. The other three times, one of them included here on this parabolic move that we had in the markets that preceded an intermediate decline in June, brought us down to this bull tag that we ultimately bounced off of. But to kind of give you an idea of the depth of that particular move to the downside. Here, let me go zoom. Oh yeah, I can see I've got it there. It is this 7% decline right there. So that happened in just a couple of days. So you can kind of get at the end of a 30% rally without a 5% decline there. So you can kind of get an idea of the kind of markets that produce strong returns on utilities, especially on a relative basis. The only other two times have been higher has been this time, which also preceded an intermediate decline there. You can see if I were to zigzag this all the way out for 20 years, we can go see that particular move in 2009. This April move preceded another 7% decline in the markets right there. Actually, it was yeah, right there in June. So that's the other time, and then the this particular time, the earlier 2009 also started more of a move like we saw in 2022. So you either get a nice little 7% decline coming off these utility runs, or you get these failures and move back to the downside. So again, that's kind of why I think we need to be aware of failures right now in the markets, because really when you look at like the Qs relative to IWM, here, let me pull that up here. You look at the Qs relative to IWM on a ratio basis. Remember, the XLK has already broken its 200-day moving average relative to the broader market as a whole. And if you look at the Qs relative to IWM, it's flirting with that. If I were to zoom back out here, let's zoom out 20 years. 20 years here. You can see in 2020, you can see that the June peak was right in this area. And then we rallied back up there once utilities started to falter. Here's that August peak right there, that leg lower. We were already below the 200-day moving average when that peak stopped. Here's the, this would be the June peak right there in 2009. We were above the 200-day moving average, no big deal. Here's the the January peak in 2009. You can see we are below the 200-day moving average. So we are way up. We are extreme at the highs here. These are like multi-decade peaks for this particular ratio, and we're not that far above the 200-day moving average. So again, if utilities leads to that kind of drop like we saw in 2022, where we spent some time below the 200-day moving average, considering the typical positive correlation with this, you can see how that might suggest a weakness ahead, especially like I said, with XLK underperforming the broader market to the tune of its 200-day moving average, and the same thing with XLY relative to XLP, which broke back down below these short-term moving averages today, and now you have a death cross. So not only are we below the 200-day moving average, but the 50-day now is below the 200-day moving average. Just barely, but now you've got that death cross there. So you can see, again, not a bullish, this is not a bullish scenario for the markets. All these other scenarios, you're above the 200-day, very bullish. When you're below it, not so bullish. It's not the most risk-on environment right now, to say the least. That's why I say, again, even if we do get a bullish trend higher, it most likely won't be, a 15-20% move again. It will most likely we'll be lucky to get up to a 10% rally, and we're already up 4%. But we've also seen, again, when utilities give up this kind of, start to get back some of these strong gains, we've seen multiple, even at the best, multiple 7% declines, much less the other declines that we saw here in the early part of 2000. Coming off of this peak here, you saw about a 22% decline plus, because there was that 5% decline there. So you saw about a 22% decline there, and then the one in 2022 coming off the August peak, you saw, again, this is ultimately probably, let's switch this to like a 10% decline. You saw a 17% drop from that August peak. So at best, it's 7%. At worst, we're talking 16, if not more on the line of a 27% decline. That's the worst case scenario. Again, when utilities start to get back these strong returns that we've had in the past, in this case, 58 days, coming off of this low point right there. Well, actually, it would be this low point over here in December with the gains that we've just barely gotten. Let's take a quick look at the sector rotation here today. Remember, yesterday wasn't so bad. We actually been getting the right sector starting to move up to the upside. As you can see, the big 3-month returns on outperformance there on utilities. So utilities and staples and real estate, we're biggest in healthcare. We're your biggest performers with materials. This is not a risk-on move, right? XLK, XLY, XLC lagging behind. The markets were up today, barely, but they were up. But by far your biggest winners were your safety trades. Again, not necessarily a risk on, right? We need to see XOK, XOY, and XLC be the big winners. Again, coming off of, let's see, we had the, it's been this 1 week and then this 2 weeks. So coming off of the cluster lows that we had, XOK and XOY are still up there despite today's weakness. But you can see utilities is now the best performing sector off of that cluster low. And again, not as we've seen in the past, that's not the sector we want to see lead a new trend higher. Usually kind of exhausts the market's move by the time it reaches such a strong short-term return. All right, despite the weakness in XOK today, it doesn't mean that all technology stocks were on a decline. Our trade idea is in that particular sector. Let's take a look at Palo Alto Networks. It's been flat. It had a big drop on this last earnings result. It has earnings coming up here pretty soon after May expiration, but you can see that the trend of the stock right now has improved. So we had cluster lows there between expiration cycles there at the end of March, beginning of April, multiple cluster lows there. But now we got dark green shading and a green line, the highest close of this cycle for multiple months now. Intermediate line is well in bullish territory. It's rising. It's almost above the 80th percentile. We're 7.75% above the moving average, which is a good amount, but not too extreme. 76th percentile. Dark green shading and a green line. You can see we're going to see bullish patterns across the board here. You got a bullish weekly candle, multiple bullish weekly candles. The PPO is turning higher. They're not very big. Hopefully, this earnings might be able to give us a little bit of a breakout here. If you obviously have 3 green arrows. The MACD and stochastics. The MACD is turning up. It's bullish. Stochastics, we're breaking above the value area. The 8 and 17 have crossed above the 50-day moving average. The 30 days almost crossing above the 50. So things are turning higher. Things are looking much better for the stock. All these oscillators looking bullish, above 60 on the RSI, well above 100, above 150 on the CCI. Looking at the Ichimoku cloud, you can see that you got an intermediate trend strength going as we're now easily into the cloud, starting to work our way through the cloud. Looking at the DMI pattern, you can see you're above 30 on the positive indicator, below 20 on the negative. That's what I like to see on the stock market. But we're seeing that here at least on Palo Alto. And then we can see also that we are in the upper quartile of the bandwidth. Bollinger bandwidth, and we're up above the Keltner channel today. So really good bullish patterns. So what I decided to do here was look at that, was at the time a low mid-30s delta, sell the mid-30s delta there, which is now low 30s delta, and buy one strike away. This is what it looks like here. So it's a relatively aggressive trade, 3-to-1. So again, you have earnings coming up. It's gonna either be make or break for this. But we got a lot of wiggle room for us to work with from a time standpoint as we work our way through that earnings announcement. This is, of course, for June expiration. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all next time.